Some critical shifts are happening in the world right now. In late February, the United States and Israel launched military strikes against Iran, and Iran has since responded with retaliation that risks widening the conflict. That escalation has pushed geopolitical tensions to levels we haven't seen in years. One of the first places those risks tend to appear is in energy markets, and this time the move has been particularly dramatic in a commodity many investors often overlook: natural gas. In Europe, natural gas prices surged nearly 70% in just a few days following the escalation. That marks one of the largest short-term price spikes in decades, and analysts warn that the impact could ripple through global gas markets as well. And that matters because spikes in natural gas prices have historically coincided with major economic slowdowns. If we zoom out, we can see that spike in natural gas prices, like here in 2000, 2008, and 2022, all occurred right around periods of recession and significant market drawdowns, which makes it critical to understand whether a similar move in natural gas could unfold from here. Now, like any commodity, the price of natural gas ultimately comes down to one thing: supply and demand. And that's where the current tensions start to matter. As part of its retaliation against the US and Israel, Iran has reportedly targeted multiple Arab nations in the Middle East, including Qatar. As a result, Qatar Energy, which runs the world's largest liquefied natural gas facility, has halted its production. That's significant for global supply. Qatar alone accounts for roughly 20% of global LNG exports, and as basic supply and demand dynamics suggest, if a major source of supply is taken offline, countries are forced to compete for the remaining available gas, which can drive prices higher. And rising natural gas prices can become a real problem for the economy. Think of natural gas as the invisible engine of the modern economy. In many countries, including the US, natural gas is the single largest source of electricity generation. It's also deeply embedded in industrial manufacturing, used to produce everything from plastics and fertilizers to pharmaceuticals and fabrics. So when natural gas prices spike, those higher costs don't just stay in the energy sector. Higher gas prices translate into higher electricity costs, higher manufacturing costs, and eventually higher prices for businesses and consumers. And that's why natural gas prices have historically had a close relationship with inflation. So if natural gas prices were to climb meaningfully again, it could start to push inflation higher as well. And if that happens, it could squeeze consumers' purchasing power, increasing the risk of an economic slowdown or even recession. However, while the current geopolitical tensions do pose a real risk of higher natural gas prices, some analysts believe the spike may not be as severe as in past shocks. During major supply disruptions in the early 2000s and again in 2022, natural gas prices surged by more than 500% at their peak. This time, though, the impact could be more contained. Analysts at Goldman Sachs, for example, have suggested that the impact could be relatively limited, particularly for the United States. That's largely because the US now has its own abundant supply. Since 2018, the United States has significantly increased its natural gas production, and that surge in production has pushed supply beyond their domestic consumption, effectively making the US largely self-sufficient in natural gas. That's a very different setup from the early 2000s when their production was declining while consumption remained high. In fact, the country has now become a net exporter of natural gas, shipping record volumes overseas. And today, the United States is the largest exporter of LNG in the world, even surpassing Qatar. Europe may also be in a different position compared to the last major energy shock, because since the 2022 energy crisis, Europe has significantly diversified where it gets its natural gas. One of the biggest shifts has been toward the United States. US LNG exports to Europe have more than tripled over the past few years. That's a major change from the situation in 2022. At that time, Europe relied heavily on Russia for its gas supply. But when Russia's invasion of Ukraine triggered sanctions and pipeline disruptions, Europe suddenly found itself facing a massive supply shortage. So as long as US natural gas production continues to expand, the broader economic impact of this supply shock could remain relatively contained. Prices may still move higher. After all, Qatar remains a major supplier in global LNG markets, but the current supply structure suggests that the spike may not reach the kind of extreme levels that historically triggered severe inflation or broader economic downturns. That said, natural gas is still a critical commodity to watch. Energy markets can shift quickly, especially if geopolitical tensions escalate further in key producing regions. At Capital.com, we look beyond the headlines to track the data in commodities that can shape the global economy, from oil and natural gas to broader macro trends. Hit like and subscribe to stay tuned. Thanks for watching.